Hi, morning everyone. Welcome back to Monica by 8. Aiman here. All right, so looking at the S&P 500, well, it closed higher, significantly higher on Monday's session. All right, morning everyone. Welcome back to Monica Pa. Aiman here. Okay, so looking at the S&P 500, well, it closed notably higher on Monday's session, gaining about 1% as the sentiment improved towards the end of the session. I think the overall tone was quite positive yesterday, with buyers stepping in back after the recent volatility. So to me, the main driver was renewed optimism around the war development after comments suggesting that the negotiation could still continue despite the earlier tension. So this helped market recover and push higher into the close yesterday. Also, at the same time, I think the market was also entering into earnings season soon, with major US banks starting to report. I think this could give some support to the sentiment as well, and as investors are positioning ahead of the expected results. So looking ahead for the S&P 500, I think the market may see continued upside bias, but with volatility likely to remain elevated, and focus will be around earnings results and also the geopolitical headlines. Right, so looking at the US trading stocks that you have published overnight yesterday, so we got here current corporation, so the stock code is COHR. Also, the stocks are experiencing a breakout at $300 level, and now we can expect the stock to travel towards the $330 level on a strong momentum, followed by the next resistance at $360 level. Now, if they counter to reverse lower, do watch out for the $265 level for the immediate support, as it could indicate a and next, we have AMD, Advanced Micro Devices. So looking at the charts now, the counter charted a high market structure, forming a higher low recently to test the 200 to break out above the $240 level. Now, if the stock to climb up higher, we could see that it might travel or propel higher towards the $270 level, and also the second resistance at $300 level. Now, if the stock slides lower below this $215 level, this might signal a shift in a bearish structure. Right, so looking at the China A50 futures, well, the market ended slightly higher or higher yesterday, showing a lot of resilience in the market. I think the peace talk also between US and Iran ended without a final agreement, right? Which has brought back some of the war nerve and a new threat of the shipping blockades. However, with the positive data of China's factory gate prices have officially returned to growth, I think this is a huge milestone that show that the China industrial is finally recovering. Looking at the technical side of things, I think the recent move has breached above this previous resistance level, showing that the bullish has returned to the market, and this could propel the market higher towards its first resistance level at 15,500 points level, right? Also, referring to the WTI futures, growth futures, well, closed just slightly higher on Monday, holding to the gains after a quite volatile session yesterday. So again, the main driver was the escalating geopolitical tension um, after the two countries' talk collapse, with the US moving ahead with the blockade of, Strait of Hormuz, blockade of Strait of Hormuz, right? And this also initially pushed the oil prices sharply higher in the session as the market pricing supply risk from the key global shipping route. However, at the later session, gains were trimmed as some hopes of possible negotiation returning and the profit taking kick in, keeping the prices from rallying too aggressive into the close. So I think looking ahead, oil prices are expected to remain still in a volatile session, with the upside bias still remain intact, driven mainly driven by the geopolitical headlines still, right? So looking at our local market, our FBMK LCR, where it closed lower, declining by 0.64% to close at 1680.52 points, while the FKL futures also is slightly. I think the overall sentiment for our local market was still in a cautious mode, with no strong buying conviction as a whole. I think mainly the weakness was driven by the raising geopolitical tension, with reports that the US may proceed with the blockade of the Strait of Hormuz. And also, I think this has raised concern over the global oil supply. And also, at the same time, the market was also tracking a weaker regional sentiment, with investors returning risk off amid the current global uncertainty, while some profit taking was seen across the index heavyweight. Uh, for our local index, right? Looking ahead, the market is expected to remain volatile and also range bound, trading in a consolidation. Yeah, sentiment will continue to be driven by the uh, uh, development in the Middle East war, right? While the lack of fresh positive catalyst um, in our local market. Um, Also, if we can see a bit here, right? So the overall for our local market, we can see the quite intense selling pressure in the heavyweight banking names, such as Maybank. We got CIMB, uh, public, and also mBank, right? Weighing on the index, reflecting the cautious sentiment in the broader market. However, the downside was partially cushioned by gains in the selected industrial and also the energy counters, notably, if you can see here, Dialog, Petchem, Hibiscus as well, and which provides some support and amid the mixed sector performance, right? So talking about hibiscus, right? Think yeah, just sharing something interesting today, which is hibiscus. So I noticed that the pullback recently completed after it has found the golden ratio level, and if you measure using this Fibonacci retracement level. So for those of you still new here, right? New to this morning kappa. So FIBO is actually the level where we can measure how deep the pullback is going to be. So based on the single impulsive wave, right? So now after we have saw that the price have touched the resistance of 2 ringgit two ringgit and 20 cent yesterday, together with the crossing of 21-day SMA line, we believe that the stock might propel higher to test the 2 ringgit and 40 cent level. And the next resistance is at 2 ringgit and 60 cent level. But still be careful, because during this consolidation phase, I think it is very crucial, and yeah, manage your risks wisely. Right, so looking at our Malaysia trading stocks today, we have Keeming. right? So the stock is on its breakout formation, higher at 83.5 cent on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel to test to the next resistance at 90 cent level, followed by 96 cent level. So if the stock to clear below the 77 cent support, this could reverse the course and trend lower together with the breach of 21-day moving average. And also next we have Samadin. Uh, the stock is experiencing a pending breakout, testing this RM1.20 level. So if the stock to remain bullish, we expect the price to propel or travel higher towards this RM1.30 in the coming session. Second resistance is at RM1.40 level. Do keep an eye at this RM1.10 level for any attempt of reversal, right? And lastly, for the FCPO, it closed slightly um, higher yesterday, rebounding modestly after the recent weakness. So still the overall tone was mildly positive. The overall trend is positive, in fact, right? But still, yesterday's move is still within a consolidation or a sideways uh, trading range. So the rebound yesterday was mainly supported by the bargain hunting after the recent sell-off, making the near-term valuation more attractive for some buyers. And not only that, there was some support from the oil prices as well, and also the expectation of the steady demand from the key importers like India, which helped to stabilize the sentiment. However, I think the upside remains limited as some of the market is still balancing against the concern of improving supply outlook and a weaker near-term demand activity. So for this FCPO, for those of you who trade FCPO, um, we expect the price to remain sideways, but in a positive way, right? With slight recovery bias, but upside will likely to be kept, lah, right? And I think traders will continue to watch the external oil prices and also the demand signal for major importers, which to me will drive the short-term direction. Okay, so that's all from me. Pass the floor to Leon. Thanks everyone and happy trading.
Hi, I'm not Leon, but I'm Eddy, and I'll be going first. Um, so basically, we have a rubber products sector update, which was published yesterday. We are keeping our underweight call here. So in essence, the report actually talks about how we view the supply chain of nitrile latex specifically, and why do we think there is some threats of raw material shortages. So overall, we are seeing, the recent geopolitical developments, including the temporary Middle East conflict ceasefire as transitory. They do not actually alter the underlying fundamental issues of structural oversupply. Right. In terms of raw materials, Malaysia glove manufacturers remain reliant on imports for about 60% of their nitrile latex requirements, with key supplies coming from South Korea, mainly South Korea actually, and the rest coming from China, Taiwan, Thailand. Malaysia is the largest purchaser of nitrile latex in the world, according to data from OEC. And we see that even with the Strait of Hormuz set to reopen temporarily, the resulting supply gap in the importable market has actually caused irreversible short-term damages. If you were to look in Korea, key NCC facilities such as LG Chems, Yosu, number 3 plant, as well as Lotte Chems, Yosu operations, they have been forced into shutdowns or maintenance. So that would have an impact on nitrile latex producers, and we think that this will effectively reduce South Korea's nitrile latex export capacity by about estimated 35%. So all in, we are still seeing the risk reward for the sector to skew towards downside. This is under our sector assumptions where we are expecting stable demand for nitrile gloves. China feedstock to be resilient, and broadly similar cost of inflation for cost of goods sold with the Chinese manufacturers. And with these assumptions, the market remains structurally oversupplied, with the East Asian giant continue to act as a price setter for nitrile gloves. As a result, just now we talked about some of the raw materials. We think that Malaysia could potentially face a squeeze where the raw material constraints would limit efficient production, while ASP upside for gloves is capped by China producers' pricing dynamics. In terms of risk of the mass switch to latex from nitrile, we only see this at about 10 to 15% of nitrile users finding latex to be a suitable alternative. So risk here there is, but at 10 to 15%. Overall, even in a tightening supply environment, the sector's upside remains constrained and downside risk remains elevated. In terms of valuations, sector valuations has rebounded to 1 times 12 months forward price to book. This is at about 1 standard deviation from its lower from its 3-year average, which we believe incorrectly priced in the return of pricing power as well as sustained margin expansion. Though we note that a tactical window for margins expansion could materialize due to positive lags in energy costs, so mainly on timing issues, that cost will eventually catch up. That's it. We are taking the opposing view. We are anchoring our thesis on potential raw material shortages, structural oversupply, and absence of pricing power, as well as persistent weak US dollar outlook. While we have made positive adjustments to reflect higher ASPs and updated our USD MYR assumption to about 4 ringgit, 4 ringgit, yes, across FY26 and to 28. Again, our overarching thesis actually remains quite cautious. So the 2-week pause gives slightly brief relief from the acute threat of raw material shortages, and all in we are still maintaining our underweight stance because of the downside risk here. In the report itself, we also downgraded Top Glove and Hartalega to a sell from neutral, and we switched Supermax from a trading buy to a neutral. That's all from me. I'll pass on to Leon. Thank you.
Hey, thanks, Eddy. So I'll move on to oil and gas sector. So basically, we have upgraded our stance to overweight from neutral, and this is because of oil price have surged amid escalating geopolitical tension in the Middle East, driven by the supply disruption risk around the Strait of Hormuz and reported damage to key Gulf refining infrastructure. While we expect prices to moderate over time, supply restoration is unlikely to be immediate given restart lags and logistical constraint. As such, oil prices are likely to remain elevated in the near term, supporting earnings across the sector. We see scope for the near-term outperformance, particularly among midstream and selected upstream beneficiary. We also have raised our average Brent crude oil forecast for 2026 to be around $82.5 US dollar per barrel and introduced a 2027 forecast of 72 barrel. Year-to-date, Brent has averaged approximately 80.5, with the first quarter this year at 77.8 barrel USD per barrel, reflecting the sharp escalation in geopolitical tension. So we have seen crude oil prices have spiked above $100 per barrel on several occasions following the outbreak of conflict in the Middle East, and this is driven primarily by the concerns over the potential supply disruption around the Strait of Hormuz, a key transit route for 20% of global oil flows. So as for our base case, we assume a sustained ceasefire with no further escalation, where oil flows through the Strait of Hormuz remain largely uninterrupted. While recent disruption to refining and downstream infrastructure are real, we expect supply to gradually normalize over the coming weeks to months. And we estimated about 3% of the global refining capacity has been affected by the recent attacks, and the several facilities have sustained operational disruption and damage, which could take time to fully restore. So as such, we expect oil prices to stabilize around the mid-80s barrel USD barrel range in the near term, before gradually trending lower as risk premiums unwind and supply conditions improve. That said, in a more adverse scenario where the conflict persists or escalate, we can see oil price rise significantly, potentially reaching 140 to 150 US dollar per barrel, depending on the severity and the duration of supply disruptions. So just a bit about our topics is currently still maintained to be dialogue and MIC, as we see dialogue offers a partial upside to higher oil price via the upstream exposure. Just to give some context, they contributed 30% of the upstream contributed 30% of Dialog's earnings for last year. So, and also the core tech terminals and the midstream business continue to provide stable and recurring earnings. And meanwhile, MIC is well positioned to benefit from elevated tanker rates as geopolitical tension and supply disruption tighten vessels availability and increase freight demands. So as for PChem, we do see we see that there's a possibility that they may emerge as a key beneficiary in a more protracted conflict scenario where sustained supply disruption and elevated oil price could keep petrochemical market tight, supporting higher product prices and improving spreads. In such a scenario, PChem could see a stronger earning recovery driven by the firmer petrochemical pricing. However, we believe the extent lens on the sustainability of the upside remain uncertain, as it is highly dependent on the duration of disruption and underlying demand condition. So notably, while the year-to-date Euro prices have averaged around 568 US dollar per ton and are currently around $800 per ton. So our sensitivity analysis suggests that the market is already pricing in the fertilizer and methanol (F&M) prices of above 600 per ton for 2026. At the current share price of 6 ringgit, we estimate the market is already implying the F&M prices between our upside 600 per ton and a high case of 800 per ton, which is still close to the former. So this suggests that the price above 600 per ton are already largely priced in, leaving the limited further upside unless a more extreme pricing environment like 800 to 1,000 for the whole year average materialize. So therefore, it's still justifying our sell call at the moment. That's all from me, and thank you for watching our morning kappa at 8. We see you again tomorrow.